I'm going to break down everything you need to know about central bank digital currencies in a way that's super easy to understand so you can stay ahead of the game. Today we're exploring the idea of central bank digital currencies, or CBDCs. With cash use declining and the rise of digital payments, CBDCs are becoming a hot topic in the financial world. So, what exactly are CBDCs? They're digital forms of a country's fiat currency, issued and regulated by the central bank. Unlike decentralized cryptocurrencies like Bitcoin, CBDCs are controlled by the central bank of a country. They're gaining traction because they might revolutionize how we handle money. With the rise of cryptocurrencies and digital payment platforms, central banks are keen on creating their own digital currencies to keep up. The importance of CBDCs can't be overstated, as they could reshape the future of money, banking, and even our economy as a whole. Welcome back to Financial Fitness, the channel where we help young adults improve their personal finances one rep at a time. Back to CBDCs, they are issued and managed by the central bank, which ensures stability and regulatory oversight. This central control can provide more security and trust for users, knowing that the currency is backed by a government entity. Let's dive deeper into how different countries are tackling the CBDC challenge. China is leading the charge with its digital yuan, officially known as the Digital Currency Electronic Payment, or DCEP. They're already testing it in major cities, aiming to replace cash and boost financial control. The Chinese government has been quite aggressive in its rollout, conducting large-scale trials and integrating the digital yuan into various aspects of the economy, from retail payments to cross-border transactions. The digital yuan is seen as a way to enhance financial surveillance and control, reduce money laundering, and strengthen the yuan's position as a global currency. In 2021, during the Winter Olympics, China made headlines by allowing visitors to use the digital yuan, showcasing its readiness for international use. Over in Sweden, they're exploring the e-krona as cash usage declines. The Swedish central bank, Riksbank, is running pilot programs to see how it could function in the real world. Sweden's move towards a cashless society has been rapid, with cash transactions making up less than 10% of all payments. The e-krona aims to ensure that the general public still has access to central bank money, even in a completely digital payment environment. Sweden's approach involves extensive public consultation and collaboration with various stakeholders to design a digital currency that meets the needs of its citizens. And don't forget the Bahamas, which launched the Sand Dollar, the world's first fully operational CBDC, aimed at increasing financial inclusion in its island nation. The Sand Dollar is designed to provide easy and secure access to financial services for all Bahamians, particularly those in remote and underserved areas. It's integrated with existing payment infrastructures, allowing seamless transactions both online and offline. The Bahamas Sand Dollar is a prime example of how CBDCs can address specific national challenges, such as geographical barriers to financial access. Other countries, such as Japan, South Korea, and the European Union, are also exploring CBDCs with varying levels of enthusiasm and progress. Japan's central bank, the Bank of Japan, is researching a digital yen to complement its existing payment systems. South Korea's Bank of Korea has been conducting pilot projects to assess the feasibility of a digital yuan. The European Central Bank is evaluating the potential benefits and risks of a digital euro, considering how it could improve the efficiency of the payment system and support financial stability. Each of these examples brings unique insights into the potential of CBDCs, while also highlighting the different cultural and economic factors at play. For instance, while China's approach is heavily state-controlled, Sweden's is driven by the need to adapt to a rapidly digitalizing economy. The Bahamas focuses on financial inclusion, showcasing how CBDCs can be tailored to address specific national priorities. So what's the key takeaway here? The potential benefits of CBDCs are significant. They could promote financial inclusion by providing access to banking services for unbanked populations. Imagine being able to make digital transactions easily without the need for a traditional bank account. According to a report by the World Bank, around 1.7 billion adults globally remain unbanked, without access to traditional banking systems. CBDCs could provide a solution by enabling people to store and transfer money digitally, even in areas without extensive banking infrastructure. With a mobile phone and internet connection, individuals could participate in the financial system, pay for goods and services, and receive payments securely and efficiently. Plus, CBDCs could enhance the efficiency of payments, making transactions faster and cheaper. With lower transaction costs, businesses could thrive and consumers could enjoy better services. For example, cross-border payments, which are often slow and expensive, could be significantly streamlined with CBDCs, reducing the time and cost of international money transfers. CBDCs also offer the possibility of programmability. This means that money could be programmed with specific conditions, such as expiry dates or spending restrictions. For instance, during a pandemic, governments could distribute CBDCs that must be spent within a certain period to encourage immediate economic activity. This level of control and flexibility could make monetary policy more effective and responsive to economic conditions. Now, while CBDCs sound promising, they come with their fair share of challenges and concerns. One of the biggest issues is privacy. With governments having more data on transactions, many people worry about how that information will be used. The idea that a central bank could track every transaction raises significant privacy concerns. For instance, if every transaction is recorded, how can we ensure that this data won't be misused or lead to unwarranted surveillance? In countries with strict privacy laws, such as the EU with its General Data Protection Regulation (GDPR), implementing CBDCs will require balancing the need for transaction oversight with the right to privacy. Then there's security. Cyber attacks are a real threat, and if a central bank's digital currency were to be hacked, the implications could be catastrophic. Imagine the chaos if hackers could manipulate digital currencies at will. This concern isn't far-fetched, considering past incidents where financial institutions and even cryptocurrencies have been targeted by cybercriminals. In 2016, hackers stole $81 million from Bangladesh's central bank in a cyber heist, highlighting the vulnerabilities that even central banks can face. Plus, we can't ignore the potential impact on traditional banking systems. If people start holding their money in CBDCs instead of banks, traditional banks could face liquidity shortages, affecting their ability to lend and offer financial services. This could lead to higher borrowing costs and reduced access to credit for businesses and consumers. Traditional banks rely heavily on deposits to fund their lending activities. If those deposits are moved to CBDCs, banks might need to find alternative funding sources, which could be more expensive. Solutions and mitigation strategies. Privacy protection. One approach to protect privacy is the use of privacy-enhancing technologies, such as zero-knowledge proofs and cryptographic techniques, to enable anonymous transactions while still allowing for regulatory oversight. Additionally, central banks could implement tiered access to transaction data, where only large or suspicious transactions are subject to scrutiny, preserving the privacy of everyday transactions. Regulatory frameworks. Developing clear and comprehensive regulatory frameworks to govern the use of CBDCs is crucial. These frameworks should address issues such as data privacy, cybersecurity, anti-money laundering (AML) and counter-terrorist financing (CTF) measures, and consumer protection. International cooperation and coordination among central banks, financial regulators, and standard-setting bodies can help ensure a harmonized approach to CBDC regulation. Public education and engagement. Educating the public about CBDCs and engaging with stakeholders, including consumers, businesses, and financial institutions, can help build trust and ensure that the design and implementation of CBDCs meet the needs and concerns of all parties involved. Central banks can conduct public consultations, pilot programs, and awareness campaigns to gather feedback and promote understanding of CBDCs. The journey towards CBDCs is just beginning, and the outcomes are still uncertain. However, the potential benefits of CBDCs, including financial inclusion, efficiency in payments, improved monetary policy implementation, and enhanced resilience, make them a promising innovation in the financial world. What do you think about CBDCs? Are you excited or concerned about the rise of digital currencies? Drop your thoughts in the comments below. And if you want to dive deeper into cryptocurrency and digital finance, don't forget to check out my other videos. See you next time.